Welcome to the 10th anniversary CFA Society Ukraine Investment Forum. Thank you for joining us today for the second session within the forum. And today's discussion will be focused on the global outlook on how the corona crisis impacted economic situations and the capital market. So I have the great pleasure to introduce you the keynote speaker of today. Please welcome Gary Baker, CFA Managing Director of Emea Region CFA Institute.
Thank you, Anna, and welcome to everyone. Thank you for dialing in today. I've got a couple of aims today. First of all is to just welcome you to day two of the conference. I mean, the fact that this is the 10th anniversary, I think is a huge achievement. 10 years ago when this started, these were quite rare events to be able to put on a conference of this magnitude. And really, it's huge kudos to CFA Society Ukraine in their ability to incorporate and collaborate with local societies. I know a number of other societies have been involved in this, in Poland, Romania, even Beijing. So my congratulations to everyone, and I hope that another 10 years will pass and we'll be celebrating the 20th anniversary very soon. So on to the main business today. I know there's a panel coming up which is going to deal more specifically with local experiences of COVID. But what I wanted to do was make a few comments utilizing a survey that we did earlier this year of our global membership on what their experiences and thoughts around COVID were. But also then I want to conclude in fact bringing in a little bit more of our research because I just also want to set the scene going forwards as well. So it's not all about just what is the now and the here. It's also trying to prepare for what happens next. So let me kick off with a few slides just explaining a little bit about the high points of a survey that we did back at the end of April. I think that's important as well because obviously for most people the COVID pandemic really kicked off middle of March onwards. So the end of April, we were 6 weeks in, and perhaps that initial total confusion and real panic had subsided a little bit. And obviously in financial markets, we'd seen an extraordinary experience. And I think the first thing to reflect on is this, I think it's very difficult in the middle of crises to get any perspective as to what's happening, how momentous things are. I started in financial markets in 1986. I've seen a lot of crises since then, of all shapes, sizes, and types. Now, this is my first health-induced or pandemic-induced financial crisis, but I think this chart of the VIX going back to 98 just illustrates just what an extraordinary year that we have had so far and we are still experiencing. So intraday, we saw VIX reach all-time highs, larger or more extreme than what we saw in the 2008 global crisis. And that sort of illustrates just really the heart attack that we saw within financial markets back in March. But obviously, you bring it up today. That prompted a big call for utilize our investment base and look at what our membership was seeing across the globe. So we put out a survey and we got about 14,000 people replying. Within that, about 20% came from Europe, and we had 17 people specifically answering questions in the Ukraine. And I'll touch on some of those points in a second. But from that data, we really established these 8 narratives, if you will. I'm not going to touch on all of these today. Obviously, your time is short and you'll get much more of the detail, I think, as you get into the discussions later on in the day. But you can see there were several areas that we were really trying to investigate and think about. Economic situation, the outlook was clearly top of people's minds. The advent of central bank intervention, liquidity, regulatory response, but then also touching on some of the repercussions. And I think certainly in light of what your subject matter yesterday on Global Ethics Day talking about ethics and thinking about ethics, and then the long-term consequences of what this might mean for the industry and for individuals, then all of that we tried to sort of capture elements of it within that the data from the survey. So let me just deal with a couple of these highlights. I mean, clearly, I think for most people, this was the big question. How do I sort of navigate this? What's that financial outlook, economic outlook, looking further afield? How do I sort of see the rest of the year? Now, bear in mind, this was end of April. And I would say, to summarize, we were a pretty negative bunch. We're pretty cautious as to what the prospects were. And that really has probably been borne out in terms of what we're seeing subsequent to that, what was a financial reaction quickly morphed into an economic reaction given the lockdowns and the responses from governments. But most people, the vast majority were seeing at that point, even then, a pretty slow, extended recovery. Nothing quick, nothing immediate. So I think there was an element of realism already factoring into people's mentalities, even back in April. But the fact that we could actually still talk about recovery really owes a lot to the fact that governments and central banks responded so vigorously and in such scale and quantity, with liquidity provision driving rates down, and then obviously that's expanded into more direct economic support as well. And that was broadly welcomed. It was broadly seen as important, necessary, warranted. So, if you look at the survey responses, swift and powerful intervention globally was necessary, yet will not be sufficient, or swift and powerful intervention was stabilizing short-term relief, which should stop as soon as possible. So, roughly half of people were saying it's great as a short-term measure, but let's get back to something approaching normal. Now, bear in mind that we're 10 years on, 12 years on from the great financial crisis, and we're seeing emergency powers enacted then, still in place now. So you can understand some of this concern that the measures taken from central banks would still be with us for a very long period of time, and people were concerned that this was going to have pretty important long-term consequences. And I'll talk about that in a second. These are some of the repercussions, though. This is, even back in April, we were already seeing there's some concern here. There's some worries about, particularly from an investor point of view, what does this mean? Where are the worries, the concerns? And that's really around asset mispricing. And asset mispricing because of low liquidity, but also because, particularly in fixed income markets, you've got this massive buyer of fixed income coming in through central banks. So, where is the price mechanism? Where is price discovery within that? Certainly huge amount of concern amongst investors as to mispricing within all sorts of markets at that point. And I don't think that has really gone away. I mean, this debate as to underlying economic conditions versus where financial markets are trading is still a very active and live one. This is one slide. I know there's an awful lot of information, but this illustrates some of the granularity we've been able to get from this survey. I don't want to dwell on it too much, but I want to just give you some of the concerns. What is most likely reason that it increases the chance of asset mispricing? And this is broken down global and then the regional breakdowns. But really what I want you to focus on is the reasoning at the bottom. Liquidity dislocation, public authority intervention, improper financial information being disclosed. So a lack of transparency and clarity because firms are enabled by regulators to perhaps stretch what they've had to disclose in the past. Similarly, government authorities giving issuers a free pass, or this ethics question coming up as well. So all of these categories are things that on various levels people have been concerned are, and that has not gone away. And here you start to get to sort of very interesting questions, I think, as to where the concerns are now. What does it mean for us as an industry if you see greater financial hardship, businesses under pressure, continued fee compression, competition within markets? Clearly, there's a large majority of people thinking that almost inevitably leads to the risk of unethical action. Whether that is because of information, outright manipulation, there is certainly a high degree of concern back then, and I don't think that has gone away at all. And really that also reflects how recent personal experience. So if you look at this is the breakdown of that data, that question on unethical action, the likelihood or danger of it. And you can see where the standout is. This is Greece. This is responses coming in from Greece as to the concerns that unethical behavior might suddenly flare up. And clearly this is directly attributable, I would argue, because of that recent history in terms of where Greece has gone over the last several years post-financial crisis and what it has done to that economy, and also what the reputation of financial services within some of those areas. Now, within Ukraine, actually, bear in mind, there's only 17 replies that we received, but there is a very similar number in terms of the proportion that are concerned that specifically in Ukraine, that the conditions that we're seeing now might also lead to unethical action. That is one of the things. Otherwise, the data set for Ukraine looks very, very similar to our global data, but on some specifics, particularly on this issue, there is a lot more heightened concern that is going to be a long-term impact and concern and worry. Let me then just deal with some of the other concerns, impacts, and this starts to now look forward a bit more, I think, as to what are the longer term implications of COVID? And again, I think that's where you're going to get into discussions on this, is to start to appreciate, all right, where could the real stresses in the system, in society really come through? And a lot of these trends are well established. A lot of these trends would not be new news to people. And I think this is one of the key things. A lot of people now are talking about, what has COVID done? What has the pandemic done? It's really accelerated trends already in place. It's really, I was talking to one particular consultant this week, and they were feeling that we've had 5 years of history condensed into 5 months. So if there was a problem with your business model at the start of the year, you really have been exposed pretty brutally by what the lockdown measures, what the economic consequences of COVID has given you. So things like large-scale consolidation, further consolidation within industries, but unfortunately also further divergence in economic benefits to rich and poor, stresses within societies, less globalization, all of those topics that we've been talking about for some time now. There is that fear, that belief that really we're seeing an acceleration and a deepening on all of those fronts. But I want to put a big but in here, and the but is that for the first time in many crises, this is not a crisis that can be laid at the door of financial markets or banking systems. Happily, you can say that finance didn't cause this crisis. This is something totally external, alien, and that's important because certainly post-financial crisis, the loss of trust within financial systems was so enormous, and it's taken us such a long time to try and regain some of that trust, that to have another crisis now caused by financial markets would have been a real death knell in some ways, I think, for the functioning of many aspects of what we all regard as healthy functioning markets. So this is one of the positives. If you can take positives from such a dire situation, it's that markets continue to function. And this was very much a message, actually, again, within the Ukraine response. This was one message. I think 80% of Ukraine responses were, the message we've got to get out is that markets continue to function. Now, you can argue that was partly because of central banks or the actions of central authorities, but they still continue to function. And that is a very important message. We did not get the complete halt in trading that we saw 10, 15 years ago with previous crises. Couple of things I want to now pivot just briefly onto thoughts for future, things to sort of bear in mind. One of them is that there's always a lot written, a lot of opinion, a lot of viewpoints, some of which are good, some of which do not really stand the test of time. And a lot of very prominent speakers, bankers, journalists back in 2008 really wrote pretty scathingly about just how unique that situation, economic crisis, financial markets collapsing, never to return again. Clearly, most of those have been turned out to be somewhat exaggerated. And today, we've got similar levels of gloomsters. Now, some of this will undoubtedly prove to be true, but are we really entering a totally new phase of our financial system? Is modern monetary theory really here to stay? Is that fiscal debate really changed forever? I suspect not, but we will see. These are opinions, but my point here is that not all opinions are really going to stand the test of time. And really, as investment professionals, we have to form our own judgment. We look at the data, we look at our experience, and we form our own judgment. I really would urge you all to do that. And that's why conferences like this are so important, to get these viewpoints from different opinions and different directions. But ultimately, you need to put that in your own context, in the context of your clients, as to what the best course of action that you need to adopt is. So finally, let me bring you up to date. And as I said, I bring in a little more research that we've done. And this is research from 3-4 years ago. We've done a succession of pieces talking about the future of the industry. And this really links to this point that what we see now is acceleration of change, not necessarily totally different elements of change. We're still working with these, what we call mega trends of demographics, technology, sustainability, government, regulation. They go through and they interact with these specific forces within finance of passive, active debate, fee compression, emerging markets, whatever you might wish. And what we've done in our research is then present a series of scenarios in things like future state of the investment profession, where we're not making predictions. We're trying to say to people, these are some of the things that you need to think about. And again, I would urge you all, if you haven't seen this research, please do look at it. It's all available on CFA Institute website. And it really is a very rich source of thought for your own situation, for that of your individual firms as well, and that future of the industry. So we went on to publish 2 further pieces, Investment Firm of the Future, and most recently, Investment Professional of the Future, where we take those narratives and those scenarios we talk about, and then put that within the context of how do firms navigate this? Be clear where you are within your firm as to what is that model that you're trying to emphasize to external clients, and what are you trying to do internally? How do you attract talent, retain talent, all of the important aspects that now more than ever we've got to be debating and thinking about for that future prosperity that we're all trying to get to. So final word on that, it's really a word to individuals as well. How do we navigate that? And ultimately it does come down to that. What is that impact on yourselves? How do you best navigate? And really the emphasis here is we've got to continue to learn. We've got to continue to adapt, to be open to change, to be open to that inputs that things like this conference, research, experience can deliver for you. And similarly for organizations, there is a huge requirement for organizations to also change, to also adapt to stronger cultures. And this one thing I would really emphasize perhaps is we talk about invest in empowering leadership. I think what has set many firms apart within this whole pandemic crisis is the quality of its communication, both internally, but also externally. So have leaders actually led because of the changes in working conditions, changes in business models, how have firms adapted? So much has come down to, I think, whether leaders are being able to take people with them on that journey that has changed an awful lot in the last 6 months. So let me end there. I wish you all the best in terms of soaking up that information. There's some fantastic people on the panel that are going to talk much more about these issues. But please, please, please stay curious, keep sharing information, talk to other individuals about it. No one has all of the answers as we go through this pandemic, but we will get through it. As I said, I think now I've seen about 15 sort of career-threatening market crises over the past 35 years. And you do get through it, but you've got to be adaptable, flexible, and have that commitment to continue to learn and continue to want to develop through that process. We can help you in that journey, I hope, as being part of CFA Institute, but a lot comes down to that motivation. So let me end my comments there, and I will hand it back to Anna.
Thank you so much, Gary. And actually, thank you so much for all the advices you gave to the audience, because I think it's priceless. And now we are just moving forward. We will start with the panel discussions. Please welcome Andriy Bespyatov, CFA and the Managing Director of Dragon Capital. Please welcome.
Hello, everyone. Thank you for joining us today. I hope it will be interesting for you. Let me first of all present our panel. We have quite interesting international team. We have Bartek Pawłowski from Poland. We have Dorian Alexander Badea from Romania. We have our old friend Attila Köksal from Turkey. We welcome him, especially as China has now a quite different situation.
Thank you.
And I will just ask probably two questions, because some of them are not related at this point to China. So probably the two questions that I think could be related would be, first of all, what are the fundamental consequences of this pandemic on your country and economy?
There was a very strict quarantine measure in place. Basically, in most of the bigger Chinese cities, people are required to stay at home and not going out. And also, people practice social distancing and also wear masks as well. So as a result, by the time when it gets to early May, we've seen basically the new confirmed cases die down to zero. So even now, sporadically, with new confirmed cases here and there, but most of the new confirmed cases are imported. For example, recently in Qingdao, one of the harbor city on the eastern seaboard, the virus was discussed on some cold packaging of seafood. So the virus is very sneaky. It's very difficult to eradicate it completely. So yeah, I think China has demonstrated that how best to control the virus, but not without economic costs. I think in the first quarter, Chinese economy was hit very hard. The GDP growth year-on-year was the worst since when we have data. All right, so no one has seen GDP growth that bad before, and I think that's because when you have such a restrictive quarantine measure, the entire economy has grounded to a halt, and also because I think fortunately because of the Chinese New Year, the Lunar New Year, so normally that is a low season because of the cold weather, and also because people go back to their hometown for the Chinese New Year. So I think that is the biggest human migration, in the entire human history. So hundreds of millions of people, move across the country to get back to their family. So I think as a result, even though second quarter was very ugly, but then at the same time, the impact on the economy is substantially less than what it would have been if it's in a warmer season, a warmer weather. So I think once we get into the second quarter, we're starting to see some improvement, and I think going into the third quarter, the GDP growth rate is coming back to about 5% year on year. Even though it's lower, it's slightly lower than the market estimate. But I think most people were looking to the strengths in importing, which is a signal of domestic demand, which is fast recovering at the moment. So I think all in all, the virus can be contained, can be conquered, and I think economy can rebound from here. I think going into the fourth quarter, as the weather gets colder, and also as we go into the first quarter next year, once again the Chinese New Year come by, then I think economic activity will slow down once again. But I think sequentially or on a year-on-year basis, we're still going to see recovery momentum going into next year, probably into the second quarter next year, simply because you have a much lower base for comparison. So I think everybody is looking for a successful development of a vaccine so that you can actually protect the population, without them having too much fear about contacting the virus and therefore impacting their consumer confidence and also consumption behavior. But I think for now, China has run a number of trials of the vaccine on hundreds of thousands of people on a very limited scope. So far, there hasn't been any incident reported, but then at the same time, the effectiveness of the newly developed vaccine is not entirely clear because there's very little information about tracing the effectiveness of the vaccine. So I think all in all, China's experience has been a good example to show how best to control the virus, and it's quite simple, really. Stay quarantined, practice social distancing, and also wear a facial mask. So it's that simple. I think in terms of the Chinese capital market, going into next week, the all-important fifth plenum of the CCP is going to be held in Beijing. So in this conference, the next 5 years growth target would be set. More likely than not, it would be about 5 to 6%. And I think besides setting a growth target for the next 5 years, China is likely going to roll out a bunch of new policies to focus on improving the lower class in the society, to help to alleviate poverty in the bottom echelon of the society. But then at the same time, probably more measures on reform and especially opening many of the industries previously with very limited access for foreigners. So I think now, for example, media, financial, banking, amongst the others, will be more and more open to foreign investors, which is a good news for the Chinese market. In terms of market performance, I think the Chinese market has remained resilient most of the time. I think even though in the first quarter, for example, the virus outbreak was looking very terrible at that point in time, the fatality rate is very high, hospital is overrun, and all sorts of bad negative news headlines across the newspaper. But then somehow, I think the market remains resilient. The market didn't go down that much, well, not nearly as much as the US market. The Chinese market only had a 1-day 10% correction, on the first day after the Chinese New Year holiday, and then the market has been climbing steadily from there. So to many people's surprise, the Chinese market has been quite steady with substantially less volatility than fear. And I think one of the reasons is because of the financial market opening. So I think the bond market in China, which previously were mostly participated by domestic investors, and now they are available for foreign investments. So over the past 2 years, we've seen tremendous fund flow coming from foreign countries into the Chinese bond market. I think most people didn't sort of aware of the fact that the rapid development of the Chinese bond market, because most people, when they talk about China, is mostly the equity market, because the bond market used to be mostly participated by domestic investors, and mostly they're the domestic banks. So when the Chinese government issues sovereign bonds, they would just buy it. So now it's available to foreign investors. So the Chinese treasury bond is AA rated with 3% yield. So it's very difficult to find globally bonds of that kind of credit rating, very high credit rating, solid, and with 3% yield in this low yielding environment. So I would say that all in all, going forward, I think the experience in both the market, the economy, hasn't been all that bad. And, it shows that the virus can be contained. And I think, hopefully the rest of the world will recover as soon as possible from this virus outbreak, and we can get back to the growth path that we have enjoyed for the past decade. I'll just stop there.
Thank you very much. Thank you for at least some information about China. I hope next time we'll organize for more time so you can
Thank you.
Participate in Q&A. Thank you for joining
Thank you.
us. Okay.
Thank you.
Okay, then we continue. We want to talk broader topic because Ukraine is kind of an open economy. We have foreign trade close to the size of the GDP. And for that reason, we chose the countries, well, first of all, China is the #1 trading partner for Ukraine in terms of foreign trade turnover. But then we also chose Poland and Turkey and Romania as all those countries are in top 5 or top 15 largest trade partners for Ukraine. And together, those 4 countries account for up to 1/3 of total foreign trade turnover. We have the broad discussion, so we're not limited just to economy or market. So this is the new paradigm, new issue with the COVID. And so I think anything would be interesting for our audience, what's going on in your particular countries. So I'll go just through the questions that we created, maybe briefly, one after one, to get a better picture about your economies and your situation. So let's start what's going on now in terms of this, how your country is going through the crisis. I don't know who wants to start, so I may start probably with Poland, as we have in the list.
Yes.
Bartek, please. Thank you.
Yes, thank you, Andriy. Hello, everybody. When you think how it worked in Poland, the first wave of the crisis back in March, we did weather pretty well, even extremely well, in terms of the kind of a health crisis point of view, because we basically had a massive lockdown that everyone adhered to. So the numbers back in March were very, very low compared to pretty much most of the other countries. So that was good not so good from the economic point of view, but good from the health point of view. Now, however, the second wave seems to be completely different. So when you look at the R0 or RO, basically the measure of how many people get infected by one particular person, then I think Poland has the highest or one of the highest numbers in the world. And our kind of issues are just building up. So it seems that while the first wave of the crisis was weathered incredibly well, the second one that we're in at the moment is looking pretty bad. So that's a challenge to deal with going forward, and it's a particular challenge because, you know, I mean, we're talking here at the CFA Society Ukraine conference, so let's talk economics, let's talk markets. Back in March, or rather April, I think the government launched one of the largest fiscal stimulus in Europe. It was massive. It basically was flooding the economy with money, which was then supported by the central bank. So there was this vehicle called the Polish Development Fund that started issuing tons of bonds and basically, well, to cut the long story short, giving people or giving companies money for keeping the staff and not firing them. Central bank supported it massively back then. Rates are at zero, just as they are pretty much everywhere else. And that's why the unemployment rate didn't really go up that much. It did go up, but not massively. Well, we basically had a lockdown. We had a freeze of the economy, which was supported by the government. Now, so that was all good and nice, but the problem a little bit, and I think this is more of a global issue, and I think when I look going forward into the next few years, this is probably the most important question to answer is how do you tackle problems like that? Because it is entirely obvious to anyone that there are some branches of the economy that will not survive COVID, right? I'm not going to go into details, but it will be very surprising if you expected the airlines to perform as well as they did before the crisis, or hotels, or the tourism, or stuff like that. So if you're a government and if you want to be a policymaker and you want to have a response to a crisis, you need to decide who to save and who not to save. So in Poland, we took a path back in the spring to bail out everybody, regardless whether you're a hotel or whether you are an IT company. And that seemed to have worked, but going forward, because the resources are not infinite, you will have to make a decision who to bail out and who not to bail out. And I think this is something that will define how Poland develops over the course of the next few years. And again, at the moment, it seems that the way the government is thinking is still geared towards helping as many people and companies as possible, without kind of taking into consideration that some of the branches of the economy are basically over. So that could work in the very short term. But in the long run, what you're doing is you are basically hindering your potential GDP growth, and therefore hindering the development of the economy. So I think that was absolutely key. The last thing I want to say is that, you know, all the panelists here, we are from countries which are one way or another geared towards the global kind of change of supply, industry, and so on. Exports, we're exporters. So there's an obvious question of the currency that is in mind. Obviously, in China, things are more kind of stable because they keep stabilizing every single market that they can possibly do, and that they possibly can, and so that's fine. But in the case of our countries here, there's been some weakening of the currency. Today, the lira is hitting another all-time low. The hryvnia has weakened substantially. The Polish zloty has weakened, but even in the eyes of the central bank, it has been weakened surprisingly little. And so the question, I think, going forward is how, as we move past this second wave, how you're going to be trying to increase the competitiveness of the economy. In the good old days, it was, you know, there is a crisis, we weaken the currency, and we hope that when it's over, people will come and invest. In a world where the IT companies are basically ruling everything and all those chains of supplies are changing, I am not entirely sure that, you know, in the case of our countries, be it Turkey with a bit more depreciation, even Poland with slight depreciation, this is your way out of the crisis. I'm not sure that in 2 years' time, when hopefully this thing is over, you know, your American investors or whoever will look at countries and say, hey, I'm going to build a factory here because the currency is cheap. I don't think this paradigm from the good old days of investing in EM holds, and this is something that I'm going to be looking going forward. I'm sure we're going to explore that a little bit further, but just for the sake of brevity, these will be my initial comments.
Thank you much, Bartek. We'll move to Dorin, please.
Thank you, Andriy. First of all, thank you for the invite to the organizers, and very honored to be in the panel with some old friends and very reputable professionals. So with regards to Romania, I would speak about three main areas. First of all, the virus. The virus hit pretty hard. We are now seeing a very aggressive second wave, and we had also we had to act very quickly also in the face of the first wave. The main worry, I would say, relates to the capacity of the health system to face a massive number of critical COVID patients. The way we reacted was with a fairly early lockdown. We started, I think the first lockdown started March 15th, and it lasted quite a while. Right now, we are facing some sort of moderate restrictions, as in some cities. So it's a strategy that is based on the level of infections, and that is, I think, the most important thing is that Bucharest is in the red scenario, which means schools are closed, restaurant indoors are closed, and that will definitely affect the economy, as Bucharest is an important component in overall GDP. Looking now at the economy, we had probably the most serious economic drop on record in the second quarter of 2020. The main shock, I would say, obviously came on the supply side, where we saw services and industry hitting quite hard. And this is coupled with a very unfortunate bad agricultural year, which adds to the problems on the supply side. On the demand side, obviously, consumption takes most of the shock, and of course, net exports, as Romania's main trade partners are European Union partners, and as we all know, Europe has been generally severely hit in economic and health and then economic terms. What is, I would say, there is always the famous phrase that this time is different, and actually it's not. Well, this time is different in some respects. First of all, this is purely an economic crisis. It's a supply shock. It's a supply side crisis, and it's not a financial crisis, as many times in our lives at least happened. We are seeing now analysis by the IMF speaking about how the economic crisis might lead to a financial crisis. So that makes things quite different, and that makes the need for intervention quite clearly in the fiscal front rather than in the monetary front, at least not exclusively, as we got somehow used to be in the monetary front. And that explains to some extent Romania's fiscal and the world generally, the fiscal position. This is where I think the most important focus should be in terms of assessing a country's forward economic stability and balance. There will be massive fiscal, let's call them, dislocations. Romania was not performing particularly well on that front before the crisis, so we were struggling with the budget deficit. We will see the budget deficit edging up a lot, whether it will be in the area of anywhere between, I would say, 7 and 10%, depending on a number of factors. For 2020, of course, I'm talking. This is somewhere attuned to the regional flavor. So I think it's higher than what you would expect for Hungary, lower than what you would expect for Poland, if I do not mistaken. So it's more or less a normal situation. And normal, when you talk about almost double-digit public deficit, seems like you're either out of your mind or you're making fun. So this normal situation has to be actually corrected at some point, and turning to the way things should be analyzed going forward. I think what is important is what happens with the economies as they adjust to the new situation, to the new economic realities. what happens in terms of economic sectors, what happens in terms of priorities, policy priorities at government levels, and how the economies and the companies in our region adapt to the new needs of the global economy. As you mentioned, we are all open economies. And also, I think an important point here is that we are all fairly, maybe, small economies when you look at the overall picture, when you look from the perspective of, let's say, a large international institutional investor. Neither of the country is per se, at the top of their radar. So if you, first of all, at the top of their radar, you probably see the advanced economies, and then if you go at the emerging economies, you see the BRICS, and then maybe you see, Turkey, and then maybe you see our countries, which regionally are quite large. So I think looking more at this region from the inside out and looking more at the regional kind of perspective, talking specifically now from the investor's perspective, makes sense. I don't think there is a lot of instruments that look at the region per se, and to look at the region from an international investor point of view, and to think about the 4, 5, or 8 currencies that you need to manage, the 4, 5, or 8 stock markets, the 4, 5, or 8 bond markets that you would need to sort of figure out to invest, might not make a lot of sense in terms of effort versus output versus efficiency. So I think I will end here this part of my answer. I think we need, and here I congratulate you once more. I think looking at things regionally and having these kinds of events, which include a lot of views from the region, is a perfect place to start.
Thank you, Darin. Moving from EU countries to another big economy, Turkey. Attila, what's going on in Turkey now in terms of COVID and related? Thank you.
Unmute, Attila.
Okay. Well, first off, thank you for inviting me to the Ukraine Investment Conference. I've been there in person several times, starting from the first conference. It's always a pleasure to speak here. Just like Poland, as Bartek mentioned, pandemic-wise, we had pretty much easy first wave, pandemic-wise, like disease-wise. But now the second wave is much more dramatic, and we had a lockdown during the first one. We don't have a lockdown now yet, and I don't know if we'll ever have one, but looks like this disease is spreading much faster now, and our numbers are not that reliable. So I don't know which numbers to look at, because the numbers that are announced don't really reflect the actual facts. Anyway, so when the crisis first started in February, March, we had the same problems that were common to other economies, like supply chain disruptions and significant decline in demand in several industries, increase in unemployment. Like our tourism revenues, tourism is a big sector for Turkey. They fell from $26 billion to $6 billion levels. So like dramatic increase, because most of the tourists we get from Russia, Europe, and Gulf. So both because of the lockdowns and also decline in revenues, I mean people's wages and incomes. So there's a dramatic decline in tourism. One of our largest sectors is textiles and ready-wear. There, the sales went down 60% year by year. Manufacturing and beverages fell about one third, about 30-35%. So really dramatic decline. But see, our problems go further back. So our problems in our economy started before COVID. Just to give you a number, our 2013 GDP was $950 billion. As you may know, Turkey is like the 17th, 18th largest economy, GDP-wise. So in 2013, we had $950 billion. And in 2019, before COVID, we had $750 billion. So there was a $200 billion drop in our GDP over these 7, 8, 9 years. And this year, we expect a negative GDP growth of 5%, so minus 5%. And next year, IMF expects a rebound, and also our finance minister expects a rebound of 5%. I don't know how this will happen, but even if that happens, we are still way behind of our peak in 2013. Overall, asset prices fell sharply. I mean, real estate, equities, like anywhere else, pretty much everywhere we observe the same thing. Then there was a recovery. In developed markets, like in the US, the recovery was enormous, so all losses were recovered. But in our case, that didn't happen. So there was some recovery, but of course, like our equities prices, for example, especially the banking sector, is today is around 1999, 98 levels in dollar terms. So dramatic decline in banking sector equity prices. And price to book ratios range from 0.3 times to maybe 0.5, 0.6, 0.7 times. So all major banks trade below book, even though they are financially not that bad in shape. But there was a big rush of foreign investors, foreign equities investors, and they sold bonds and equities and everything. And so today, as of today, the free float held by foreign investors is at its lowest level ever since I remember. So because traditionally, foreign investors, which are mostly long only funds or like big fund managers, they held almost 2/3 of our free float. Now it's lower than 50%, around like some 40% levels. So that's a major issue. And M&A activity is at a multi-year low. So usually, on the average, we get $10 to $15 billion like foreign investment inflow into Turkish companies. And in 2019, it was 8.4 billion. This year, it will be much less. So we are really maybe going towards a balance of payments problem, like slowly, because we have a debt service of $182 billion in 1 year. And our total reserves, including gold, is $84 billion. So Turkey still can roll most of its debt. I mean, we have lots of long-term Eurobond investors, but things are getting more and more difficult. I think the decline in the oil prices helped us on the positive side. So we saw some benefit of it, especially when it came down to very low levels in April, May. So that's a plus. And so I think we'll have another round, right? Maybe I'll just wrap up here. But the Turkish economy, unfortunately, doesn't look that bright. And the only reason, unfortunately, is not COVID. We have several other issues. Some geopolitical issues, maybe we'll talk that later, because I know Dorin wants to leave, so maybe you may ask another question and I'll go on later.
Okay, thank you, Attila. Another issue which is probably common right now, in that respect, maybe it's good that we don't have China, because they have a totally different situation. And we all now talk about the second wave and what should we do. And for example, in case of Ukraine, we have like in a few days, we have some local elections, and many people say that, look, before the election, the authorities do not want to impose any major or stricter lockdown. and after that it is possible. But at the meantime, we are not a rich nation, and you probably heard that even France saying that it's very, very expensive, even with all their support and printing money, and still difficult to make some nationwide lockdown. So do you think in terms of your economies, do you think that your countries can withstand those lockdowns? Do you expect them? Or maybe what are the alternatives that your governments are considering or implementing right now? Maybe you have some special thoughts. I'll probably start this time with Dorin and go with other speakers later. Dorin, please.
Sure. So it's obvious lockdowns are super expensive in terms of their impact on the economy. So I think everyone is, I would expect everyone at policy making level, at government's level, is clearly aware that the lockdowns are, if not unsustainable economically, at least extremely expensive, and the only thing that we can do about those that bill, footing that bill, is to have debt, so to essentially push the economic burden down the road. So I think it's only rational that lockdowns, at least complete lockdowns, are avoided. There is a lot of debate about how prepared we are for various scenarios in Romania, and I have to say I don't have a clear answer. I think there's a couple of things though that I would highlight, and I think the first very important thing for sustaining different waves and the effect of the health crisis per se is to treat it is to look at the critical points, and there are two critical points. The first critical point regards the critical patients. So you want to have as much capacity in your intensive care units, in your COVID kind of dedicated medical facilities, to face as much as possible ample large numbers of infected of critical patients. So that's very important. And here there are different ideas and different schools of thought. So people obviously say, it takes 10 years to train an ICU, a emergency unit doctor, which is true. On the other hand, we are not in a predicted scenario. We're not in a perfect situation. We are in a scenario which can be linked to the situation of a war. So if you have a situation like this, which is critical, which is life-threatening, I think it calls also for unorthodox or less standard measures. So even if it's difficult, I think we should prepare as much as possible for expanding the capacity to take on critical patients in emergency care units. And the second important area with dealing with the health crisis and in order to avoid lockdowns is to identify as much as possible the population at risk and limit as much as possible their exposure to the virus. So targeted lockdowns, a lot of education and awareness around the risks that people are taking should be conducted. So these are my two takes on the lockdown. I don't think, personal view, I don't think anybody can and should can afford and should take the bill for a full-scale lockdown again.
Okay, but let me just a small follow-up question. Like in Ukraine, we had today for the first time, I think we had a little bit over 7,000 cases. The president said, like, if we have close to 10, 9.5, then they would consider or implement the full lockdown. Do you have any talks like that in Romania, or some kind of adaptive, or this targeted lockdown is kind of a major priority, and kind of full lockdown is not an agenda like it was in Israel, in Iceland, or some other countries now?
I'm not seeing discussions about full lockdown. What we are doing right now is to monitor regions, and we have three scenarios: the green, the yellow, and the red scenario for each region. The red scenario is activated when you have more than 3 cases per 1,000, more than 3 new cases per 1,000 inhabitants, I think in the last 14 days. So, and we, as I mentioned earlier, Bucharest, which is by far the largest city in the country, accounting for something close to 1/3 of the GDP, is now in the red scenario. But
Okay.
that's not a full-scale lockdown. I'm in my office right now. About 1/3 of my colleagues are in the office right now, maybe a bit more. It means schools are closed. Why? Because it's more difficult to educate and monitor kids in terms of the health prevention measures they take. It means restaurant indoors are closed. So this kind of measures are activated, which hurt the economy, but still, allow it to function.
Okay, thank you, Darren. Bartek, please, about Poland. What do we have in Poland right now? Or
again, I mean, I think in many countries you're trying, or everybody's trying their very best to avoid a lockdown. So there are those rules-based decisions that, just like Dorin said, whenever there is a county with a few cases per 1,000, then you introduce code red. At the moment, pretty much the whole of Poland is about to get into the red zone, which isn't a full-blown lockdown, but we're getting pretty close to that. I'm not entirely. I mean, you mentioned about the elections. I think there's always some elections at some point everywhere. These kind of arguments are a bit silly, in my opinion. We had in Poland elections, big problems with the presidential elections, which were postponed into the summer and so on. But honestly, who cares? We're dealing with a crisis. Somebody needs to deal with that. And I don't have a perfectly good answer on how to deal with the pandemic. The only thing I can do is just look east, have a look at what Korea did, have a look at Singapore did, to some extent China, although I'm not sure the Chinese example is a perfectly valid one for European countries. But yeah, Korea, Japan, those sort of Far Eastern economies and countries, they've dealt with that, and we just need to do the same thing. That's as simple as that. And in my job and my kind of day-to-day work, I'm more focused on the economic implications. I think what you said about the printing, I hate the word printing, but okay, let's go with that. The sort of ability to repay potential debts, and I think I'm sure at some point we're going to move into this discussion, but there is a big talk about what kind of recovery we're going to get, and there's not going to be one size fits all. There's going to be countries which are going to benefit from that and countries which are going to be the losers, and there will be really no middle ground. I am fairly certain, in my opinion, that the recovery that we're witnessing is this K-shaped recovery, which means that you have a bunch of economies, a bunch of countries who are benefiting, think tech, and you have a bunch of countries and a bunch of sectors who are absolute losers. Attila mentioned about banks trading at price to book value sub 1. This is pretty much all around the world. I don't think you have, maybe US banks are a little bit higher, but in principle, and I work for a bank, this is not an industry that is perceived as particularly, good for the future. It doesn't mean that the banks are going to collapse. They will not. But it means that as your business, it doesn't really work. Then you have to start asking yourself a question: Is the UK a banking hub? Is it a very good place to invest going forward? So again, I mean, at this stage, what you need to be thinking is how to be in this upper leg of the K, and how to deal with the post-COVID. I mean, us finance people, we're not going to come up with a solution for the pandemic. So that's that. And I think another question, which I think Dorin mentioned, and to extend that a little bit, is that a few years down the road, maybe a decade down the road, aren't we going to basically have 3 groups of countries: the dollar zone, the Eurozone, and the yuan zone? And basically, I think our economies here, probably mostly Poland and Romania, to some extent Ukraine, and maybe at some point when the president changes, also Turkey. We need to be thinking, and this is very political, do we really treat our own currencies as independence and we want this and we think this is important for us, or do we see what's happening at the moment with huge spending that the EU is about to unleash, with the ECB, which is a credible central bank that can fund it, and so on and so forth? Do you really want to walk alone, being kind of somehow patriotic, but this is a misguided form of patriotism? Or do you want to be part of this, in our case, the Eurozone, with all these fallacies, but basically be part of a group of countries where you have the highest chance of going up in this K-shaped recovery, rather than sticking to countries which just stay somewhere on periphery? Yeah, they're fine, but they're not part of global investments. They're not part of any new green deals. They need to basically fund themselves on their own, which we know will not work. And the biggest example, and I think Dorian confirmed that, is that since the EU entry, this was the biggest source of funds in our countries. And this is basically also one of the differences why, for example, GDP per capita in Poland is so much greater than GDP per capita in Ukraine. Obviously, there's the big brother in the East that also has had some impact on this. But at the same time, this, international cooperation with huge bodies like the Eurozone or the dollar zone or the renminbi zone or yuan zone, which is going to be absolutely crucial, this is the way to go. So again, we can talk about the pandemic. I think the responses are pretty similar among countries with a bit of wrinkles around the edges. But overall, you need to make sure how you're going to fund yourself going forward in this new world where the fight for resources is going to be even more fierce than before.
Okay, Bartek, thank you.
Andriy, if I can add
Sure.
a couple of things,
Sure.
because I think it's super interesting. There's two ideas that Bartek's intervention sort of brought to my mind. So first of all, with regards to the shape of the recovery, I'm a great believer in the so-called square root or radical shape recovery. So I think and the reason I think it's important is not because it sounds interesting to talk about a new sign rather than the usual letters, but because it highlights some problems which we have in terms of behavioral biases and psychological expectations. So when we're speaking about the radical shape or the square root sign recovery, we're talking about a sharp fall and then sort of a recovery, maybe halfway recovery, but then stable or problematic road ahead. So imagine the square root sign. And I think why that is important is because everybody sort of talked about letters, and when things started to jump back higher again, everybody was very enthusiastic about the V. And I think, if you think about it, a quick recovery to some level after this large economic corrections as the lockdown stopped was normal, but the road ahead is pretty bumpy and difficult, and I think that's super important to always remember. So my take at the macro level is we're either looking at a square root recovery, so partial recovery to the pre-crisis towards the pre-crisis levels, but not there, and then a very bumpy and difficult sort of parallel way ahead. And the second alternative, which depends a lot on the reaction to the health crisis and that I think in turn depends throughout the world on the capacity of the medical systems to take care of critical patients. The second alternative is the famous W, which we all more or less dislike. And at micro level, at sectorial level, I think indeed there is a K shape. I would say it's a K-shaped risk, because the K comes with a lot of inequality, and the world already, in terms of social rest or unrest, already has a lot of inequality, and that leads to important risks ahead. And the second thing that I would like to mention with regards to geopolitics is, and here in full disclosure, I'm also involved as I'm a member of the board in the Free Seas Initiative Investment Fund, which is the first regionally focused infrastructure fund in this part of the world. So it covers the 12 European Union member countries between the Baltic Sea, the Black and the Adriatic Seas. And I think there's two things to say here. First of all, a lot of regional identity or cohesion rather than identity, a lot of regional cohesion is an opportunity at these times of crisis. And infrastructure as a driver, as a economic opportunity, as an investment opportunity for the governments and for the capital markets is quite important. I remember, and I'm sorry we don't have our Chinese colleague in the panel again. I was seeing a presentation a few years back when we were discussing whether China will be able to continue its stellar economic growth. It was a professor from Tsinghua University in Beijing, and he was saying, look, so far in terms of economic growth, the main driver was, one of the main drivers was public spending, public investments. And it was fairly easy. I mean, it was easy to imagine that if you build a railroad or a road between two cities, two metropolitan areas with 10 million plus inhabitants, that's going to be a good investment. And you're going to drive growth with that investment. As you build it and after you build it, it will have a positive economic effect. As it gets more difficult, as you have to think about continuing the same public spending, government spending and infrastructure build up, to connect less attractive economic areas, it becomes a question whether that spending is efficient. So I think right now, if we look at this region, particularly on the north-south axis, we have a lot of important investment opportunities in infrastructure. So it takes you, 2 times as long to get from the south of Europe in Sofia or Athens to Poland or the Baltics as it would take you to get from Barcelona to Stockholm. 2 times as long, either if you do it by rail or by car. So a lot of infrastructure investment is needed in this area. Then you look at digital infrastructure. Data traffic increased in the double digits, I think close to 20% in the region, so in our countries throughout the COVID crisis. So that leads to a lot of needs also in terms of data center investments, and we're seeing a lot of companies like Google and Amazon and Microsoft announcing investments in big data centers in Poland. We're talking, I think, $2 billion investment by Google, $1 billion investment by Microsoft. I think there was an announcement about a data center by Microsoft in Ukraine. So there is a lot of potential, and the big international companies are seeing this. And I think also us as either capital markets professionals or bankers or policymakers in the area should see this kind of opportunity.
Thank you, Dorian, a lot. Just in case you leave, as far as I know, before the Q&A, for the audience, we had this little technical issue, so we'll probably finish about in, 8-10 minutes maximum. So Dorian, thanks again. We'll move now to Attila. I think for Ukrainians would be important, and Romania definitely. But we have 2 problem major flows. Labor migration goes to Poland. And if you ask pretty much everyone, or many people, who went on vacation outside of Ukraine this particular year, probably 80% would tell you about Turkey. So the situation about the lockdown, and probably as Dorian and Bartek started in terms of this shape potential, so the perspectives of the economy for the next year. So probably these 2 questions for us, and after that we will sum up and go with Q&A briefly. So Attila, please.
Okay. Well, Dorian mentioned about behavioral biases, so I'd like to touch on that, because now all of us, the whole world is under this bias called recency bias, where we think that we'll be in this situation for almost forever, because as you may know, recency bias gives weight to more recent events, and in our decisions we get influenced by whatever is going on in the recent times, like 1 month, 2 months, 1 year, and we think that this will go on forever. I saw a survey on Turkish Twitter about 4 months ago. I think it was in April, May. And the question was, when do you expect the Turkish economy to go before COVID levels, pre-COVID levels? And there were 12,000 survey takers, which is a good, sizable sample size, right? And 60% said never, never. I mean, that's so dramatic because I think we are all under the influence of this, and most of us think that life will never be the same, and that impacts our decisions. And in Turkey, I mean, like we observe this, there's a dramatical shift in people's investment habits, and people buy US dollars like anything. And now, as of today, the foreign currency deposits of Turkish people in banks is $240 billion, which is like 60% almost of all deposits, more than Turkish lira deposits. And under the mattress, we keep somewhere between 150 to $200 billion. So we are talking about some like $300 to $400 billion. We don't know the exact amount of the under the mattress, but somewhere between $300 to $400 billion in foreign exchange, and some of it, of course, in gold also, foreign exchange and gold. We imported $20 billion worth of gold this year, and most of it went to the mattress, under the mattress. And this is an economy which needs funding, right? I mean, we just went out to a Eurobond issuance about 2-3 weeks ago, and for $2 billion, we ended up paying 650% spread over US treasuries. So there is this huge wealth in the country, within the country, but that doesn't really help the economy because it's kept in either foreign exchange or even at home. So we need to change this mindset, but of course, I mean, we can't change it. So it's the trust issue. Like somehow the governments have to create trust. That's one single problem in Turkey. And I think once the vaccine is found and once its production starts, of course, it's a matter of time. But I think that will initiate a recovery phase, and slowly, I think maybe by 2022, we'll slowly start thinking of getting back to the good old days. I think that's one most important issue. I think, and governments have to do whatever is in their hands to really gain trust of people. And unfortunately, in Turkey, we don't do much in that side. And coming back to your question, I don't think a lockdown in Turkey, a second lockdown, it's out of question because it imposes a big burden on the government budget, and government did a huge fiscal stimulus just like anywhere else, like Poland, everywhere. But that increases because they print money, and that increases inflation. And Turkey has a sticky inflation problem. We always had an inflation problem. Even now, everywhere inflation is down to zero levels, but we have 12% inflation. And government has been trying to do interest rates low. Central bank has been trying to keep it at 12% level that means 0% real interest rate. And that even increases the appetite of people to buy more foreign currency denominated assets. So, it's a tough process, and I don't think we can afford another lockdown. So we just have to go on and hope that a vaccine will be introduced soon and will be distributed over time. And that's it.
Thank you, Attila. We have probably time for a quick probably answer for one question regarding banks, financial institutions, and how can they help small, medium enterprises to overcome this crisis. Bartek, maybe a few words if you can.
I don't think they can, to be honest. I mean, the banks, look, I can speak from the Polish perspective, but I don't think it matters that much across Europe. So you're talking about the banks which are well capitalized, but at the same time, at the moment, this is not something. Well, banks don't want to give out credit. So basically, if you want to give credit to somebody, then this somebody doesn't need it, and if somebody needs it, then you don't want to lend to him or her. So that's a sort of catch-22. I don't think it will work. We may work on some sort of mortgage lending, that kind of stuff, but at the same time, lending for mortgages at this point in time is neither particularly profitable for the banks, nor is it particularly good for the economy. So I don't think that will work. So basically, we're dealing with the situation where you have a hole in private demand, generally speaking, and this hole has to be filled with the government. So what you need to be doing is you need to be using the public balance sheet one way or another to either provide guarantees or outright lending. At this point in time, despite interest rates where they are, the banks, and this is everywhere, are much better off from on a risk-adjusted basis to keep buying government securities, putting them on hold to maturity or available for sale portfolios, and just waiting, because otherwise nobody really expects the banks to suddenly start lending. And so sorry to be sounding downbeat, but this is not the time when you can reasonably expect the banks to pick up the baton and to lend without some support from the government, particularly as interest rates are zero or in some cases negative, which really doesn't help banks at all. So, and the curves are very flat, which is another hindering factor. So you need to unleash the bank's capital, but for that you need some guarantees from the government, and without that we're not hoping for the banks to step up to the challenge. We've seen that hopes happening in the Eurozone for the last 10 years. Nothing has happened over there, and there is no reason to think that in this crisis, which is huge, and a huge demand drop and huge unemployment increases around the world, that the banks will just suddenly bail us all out. This is not how it's going to work. Banks need to be supported.
So I think the key situation in Ukraine probably is even worse, because Poland is probably much more healthy, the economy. I would assume that in Turkey it's probably not a question right now. Correct, Attila?
Yep, exactly. The Turkish banking regulator imposed new rules on asset ratios to force banks to give loans to companies. But you can only go so far, because then you start increasing the non-performing loans of the banking sector, and you create a bigger problem, a much bigger problem. So I agree with Bartek. It's you can't really expect the banking system to carry the burden and just take the small medium enterprises on their shoulders. It's not possible.
Okay. We run out of time, actually. I would like to do two things. First of all, to thank our regional friends for joining us in our online initiative this time during such interesting times. The second, just for our audience, again, thank you for joining, and to remind that tomorrow we'll talk about Ukraine situation with the COVID and the economy, and what's going on with the industries and companies particularly, which should be also very interesting. So thank you very much. Stay safe, and see you tomorrow.
Thank you. Stay healthy. Take care.
Goodbye.
Bye-bye. Thank you.